This analysis is for educational purposes only and is not an investment recommendation.
Amazon functions as the foundational infrastructure for the modern physical and digital economy. The foundation is a massive physical flywheel. The logistics network and the base of 200 million Prime members function together as an engine, generating the consumer data and structural scale required to lower unit costs. This chart details the $717 billion total revenue generated in 2025. While categories like online stores provide the base, the orange and yellow bands, AWS and Advertising, are the real financial engine. The lower margin retail operation feeds these high margin digital segments. Building that physical network required over $100 billion in capital expenditure. But that physical footprint allows the digital segments on top to generate significant cash. Over the past decade, the rapid expansion of these digital segments has shifted Amazon's core profit drivers away from the warehouse floor. The business model operates as a self-sustaining cycle, where retail scale generates the capital required to expand into high-margin cloud and advertising markets. A great business combines operational leverage with a physical scale that competitors cannot replicate. This chart tracks operating income. In 2025, the green margin line expands to 11.2%, generating nearly $80 billion in profit. Notice the massive jump from the 2022 baseline. An operation previously running at near zero margins is now extracting record profits. Management executed a strategic shift in the retail segment, moving the division from a period of aggressive expansion into a profit extraction phase. This chart details phase 3 of their capital cycle. By regionalizing their fulfillment network, they drove the proxy return on invested capital for North American retail to an all-time high of approximately 27%. They have built significant physical barriers to entry. With 2 million third-party sellers relying on their logistics, duplicating this footprint at scale is a capital challenge that few competitors can meet. The core retail moat is secure. The defining challenge for management now is how efficiently they allocate the cash flow at harvests. With logistics largely optimized, future profit growth relies on the expansion of cloud infrastructure and advertising. This chart of quarterly revenue shows the re-acceleration of AWS. Driven by generative AI workloads, growth ramped to 23.6% by the fourth quarter of 2025. But this next chart reveals the cost of that acceleration. The green line shows AWS operating margins compressing to 35.4% as the company absorbed new capacity investments. AWS is currently situated in the middle of the AI cloud value chain. Below them, hardware providers like NVIDIA possess high bargaining power. Above them, frontier labs like Anthropic and OpenAI develop the proprietary models that could bypass the cloud layer. To protect their margins, AWS is pushing outward. They are developing custom silicon like Trainium to reduce hardware dependency, while offering managed services that increase customer lock-in. Alongside cloud, the advertising segment reached $68.6 billion in revenue, operating at high incremental margins. Prime Video transitioned into an ad platform by default, giving Amazon access to 200 million viewers with existing purchase histories. This creates a closed loop for brands. A company can run a video ad on Prime Video and track exactly whether that same viewer bought their product on Amazon the next day. Amazon's evolution hinges on acting as the primary toll collector for both AI compute and digital advertising. Directing this shift is Andy Jassy, the executive who originally built AWS into a $100 billion run rate business. Jassy's management style pairs strict cost discipline in retail with the willingness to commit to long-term infrastructure bets in cloud and AI. This chart tracks capital expenditures as a percentage of revenue. The sharp upward slope on the right marks a record $128 billion investment cycle authorized in 2025. Management's incentives are aligned with long-term capital compounding. Jassy receives no cash bonuses. His compensation is 100% equity-linked, with $242 million unvested and tied to stock price performance through 2031. This culture still functions across 1.5 million employees. When AWS realized their initial bedrock architecture couldn't scale, a small team of engineers rebuilt the engine from scratch in 76 days. This leadership team is culturally wired and structurally incentivized to execute the largest infrastructure build-out in the company's history. At 25 to 27 times forward earnings, the valuation sits at a reasonable historical average for the business. The investment thesis relies on a balance between current retail efficiency and future cloud investment. That $128 billion investment cycle caused a drop in free cash flow, which fell from $35.5 billion in 2024 to $9.3 billion in 2025. Amazon is self-funding this cycle from internal operations. They ended the year with a low leverage ratio of 0.26x net debt to EBITDA. This chart illustrates how the market views the current spending. The flatline stabilization of the 2026 revenue consensus indicates that analyst estimates have bottomed out as the monetization path becomes clearer. Current multiples suggest an 18 to 20% expected return, provided the company maintains mid-teens earnings growth and retail margin stability. The valuation is reasonable if the current capital drain successfully converts into higher margin AWS cash flows over the next 24 months. There are risks heading into 2026. The primary financial concern is a CapEx overshoot. Management projects $200 billion in expenditure, which must yield clear AWS returns to justify the pressure on free cash flow. A potential long-term risk is agentic commerce. If AI agents begin purchasing directly for consumers, Amazon's user interface and its $69 billion sponsored ad model could lose their relevance. External pressures remain. Ongoing antitrust cases target marketplace practices, while potential tariffs on Chinese goods threaten the retail supply chain.
Despite these risks, the performance in 2025 suggests that Amazon's core segments can expand simultaneously without eroding the company's consolidated margins. The company reached record retail efficiency while seeing cloud growth reaccelerate and advertising profitability scale. Partnering with Amazon requires patience. Management continues to prioritize decades of infrastructure dominance over quarterly cash returns, investing through every cycle to maintain their scale.